This is video 4, dealing with an example that combines IAS 8 with IFRS 9, specifically shares in IFRS 9. We're looking at the last little bit of the given information. It is the accounting policy of Aqua Limited to account for shares that are not classified as inventories by only restating the portion of shares sold to fair value on date of sale. On acquisition of new shares, any shares already held before the acquisition are restated to fair value. So what are they telling you? They are telling you what their accounting policy is if they have share transactions in shares that they are trading with, but they don't classify them as inventories. Now, you should know from your IFRS 9 information that shares that you are trading with fall in the category at fair value through profit or loss, and that these shares initially on day one are measured at fair value. You are not allowed to include the brokerage. The brokerage has to be an expense immediately when it takes place. These shares subsequently, which means at every year end, needs to be measured at fair value. Any fair value adjustment, whether it's upwards or downwards, goes through profit or loss. When you sell shares, you need to first do a fair value adjustment, because you should not show a profit or loss on sale, because if these shares are in the category at fair value and you sell them at fair value, you should not make a profit or loss. On sale, if there is brokerage, it's immediately an expense through profit or loss. Those are your IFRS 9 rules, and they just gave you a bit of guidelines. When do you do fair value adjustments and on which shares? What is their policy? How do they do it in their company? Now, in this question, we could have gone straight to asking, disclose the error note. If we ask that, the IAS 8 implications, you need to know, you need to start with what was done. Now, luckily, they gave you bullet points explaining exactly what they did, and they gave you the journal entry. So you didn't even need to write those journals to try and figure out to put the what was done bullets into amounts and into journals. They gave them to you. Step 2 is what should have been done. Now, what should have been done? These shares should have been treated as shares. They should have been in the category at fair value through profit or loss, and those rules should have been applied. Now, we don't give you the journals of what should have been done in 2009 and 2010. You will need to go and write those journals, because step 3 is, what are the differences between what was done and what should have been done? Now, if you don't write the journals for yourself, what should have been done, how will you identify the differences? Once you have the differences, you go and correct them. You write the correcting journal entries. And in this case, we actually specifically ask you for those correcting journal entries. In number A, prepare the correcting journal entries that will be processed by Aqua Limited's accounting records. So now remember, when can you post them in Aqua Limited's accounting records? The 2010 accounting system can be opened, but the 29 accounting system cannot be opened. To correct the error. And then they give it away a little bit, because you should have known this by yourself. If you can only post journals in 2010, there should be a journal fixing the opening balance in 2010. But they sort of give it away. They say the correcting journal entries must include the correcting of the opening balance on 1 October 2009, which is opening balance of your 2010 financial reporting period. So we didn't need to tell you to do the correcting journal entries. We could have gone straight to do the note. You need to know the steps. What was done? What should have been done? What is the difference? Correct the difference, and then disclose it, because you need to tell your users, I have fixed errors that were in my prior financial statements. What amounts did I fix? What line items? If you look at the financial statements, every single line item that I changed. So important, line items. What on the face of the financial statements did I go and change? What amounts? In which line items? Your users need to know, because remember, they have seen those financial statements that had the mistake in. They've seen the 2009 financial statements. They've seen the 2010 financial statements. Tell them, what did you change? With the correcting, what line items are now different? What amounts are different? Part B of the given information is not about IAS 8. It's not correcting. We ask you, do the journal entries for 2011 the right way. You were still busy with the 2011 year. They specifically told you no share transactions had been accounted for in any case. So just do them. Do them correctly. In terms of the rules of IFRS 9, that has nothing to do with IAS 8. That is the current year. You are still busy with it. They just told you hadn't processed anything on the share transactions yet, so just go and do it. Normal IFRS 9, nothing to do with IAS 8.